All right, guys, I think we're ready to get started here this evening. I think you should be able to hear me okay right now. But I want to welcome you all to the strategy session series brought to you by Learning Markets. My name is Jeff Kohler. I'm actually a new kid on the block here tonight. Going to be my first presentation with you guys. Hopefully you'll be out and attending many more with me in the future. But tonight's presentation is going to be plunging into the real estate market with Reits. Now, before we get started, just want to let everybody know that I'm not an employee of or affiliated with Scottrade. And what I'm going to be talking about today is my opinion and my opinion alone, and does not reflect the opinion, belief, or recommendation of Scottrade. Now, as we get started here this evening, just want to let everybody know that in these presentations, I like to communicate with each and every one of you. So if you have any questions at any time, go to your participant panel and click on the Q&A icon where you can reach me. I'd like to interact with many of you throughout the session. And also, the resolution of the presentation tonight might not be best fit to your settings, so if you'd like to enlarge or reduce or make any changes there, just right click anywhere on the screen to change the session or the settings there. All right, so as I mentioned, let's start just really quickly with what the basics of a REIT is, if you have heard or have not heard of these before. What a REIT is, or what it stands for, is a real estate investment trust. And so what these real estate investment trusts are companies that issue dividend through income properties. So many of you might have experience in the real estate market, whether you have some rental properties, or a lot of people will invest in all kinds of different things, whether it be storage units, or if you've ever been in retail, maybe a retail property, office space. I mean, all these things are what real estate companies invest in. And what they do is they issue dividends through these income properties. So from the rental income that they receive, they distribute that out to shareholders in the form of dividends. So these REITs, if you've ever traded a mutual fund before, I like to think of it as kind of similar to a mutual fund, in the way that the mutual fund goes out there and buys a lot of different shares of various companies, and then you buy a share or a portion of ownership into that fund. Well, it's really not all that different with REITs, in that it trades actually more like a stock than a mutual fund, but the components of the stock are kind of similar to a mutual fund, where they're made up of various different rental properties, portions of real estate, and that can be like office buildings, shopping malls, apartment complexes, hotels, hospitals, etc. And so these REITs, they invest directly into that real estate, and through these companies that own this real estate, rather than you going out and taking the risk of purchasing one of these properties yourself and going through the headache of trying to manage it and whatnot, you just buy a share of one of these stocks and get to have a portion of the ownership in said real estate. Now, there are some benefits and some drawbacks, and I wanted to talk about those just really lightly before we get into most of the details. But one of the benefits of investing in REITs, like I mentioned, real estate is a really important component of anybody's investments. Whether that's to buy REITs, or whether you want to go out and invest in something like a storage unit, or you decide to invest in a duplex and turn around and rent those properties out. The benefit here is really you get to invest in the individual stock, and depending on the stock, that can offer some pretty decent liquidity. So one day, if you change your mind about the state of the real estate market, or the particular genre that you're investing in, you can hop right out. You can hop back in. Whereas if you actually go out and invest in real estate, it's not that easy. You can't just decide one day to up and get out. There's a longer process involved in moving an actual physical portion of real estate. Another one of the big benefits, and one of the things that I enjoy most about investing in REITs, and that is, they're a dividend-paying investment, and a lot of these companies offer a pretty decent yield. When you consider what treasuries and what those things are currently yielding right now, they are higher paying yielding investment. So another benefit is you get the exposure of different areas of real estate. And what we're going to talk about tonight is we're going to look at a bunch of different companies, companies that will allow you to invest more in, let's say, apartment complexes. Because when you think of the real estate market in general, it's not just, might not have market conditions that are conducive to all forms of real estate. If you think of economic conditions right now and the fact that the job market's pretty soft. Obviously, labor market hasn't totally gotten on track. This isn't the best time for companies to go out there and start really bringing in their, starting to take on more office space, right? And things of that nature. So you can use REITs to specifically segment what portion of the real estate market you're interested in and go with a company that specializes in that, whether it be a company that owns a lot of hospital real estate. Let's say for if you're looking more at a healthcare angle, or apartment complexes, or shopping malls. If the consumer comes back online, they start spending more. Well, then investing in a real estate investment trust that specializes in retail and commercial real estate might be a better choice. And the great thing about these guys is they trade just like any other stock. So if you go out and buy shares of any different company, really the REITs that we're going to talk about and some of the ETFs that will track these individual REITs in the real estate market, they trade like any other stock. So you can buy shares, short shares, you can opt to trade options. Really, there's no difference in these as opposed to any other equity investment. Like I said, I think the biggest benefit here is you might not be in a position where you want to go out and take on a rental property and start renting that out to tenants and deal with the headache of finding new tenants and drawing up contracts and the upkeep on the actual property itself. Shoot, we're just buying and selling stock, right? That's the best part of it in my eyes, is that really I can take advantage of the type of real estate that I'm most interested in, and I don't have to deal with all the headache of the management aspect of it all. All right. Now let's talk about the shortfalls of investing in REITs. One of the things that I notice in my experience in dealing with REITs, that they're a little bit higher beta. And what that means is, not every stock trades at the same rate of the overall market. And, beta is a really good risk measurement when you're trying to determine how much a stock will move. So let's say the S&P moves a point, right? If we've got a lot of stocks which we were coming out of a pretty high state of correlation where it was easier to measure beta, but some stocks will move much more for every point increase or decrease in the broad market. And a lot of these investments, I tend to look at them as being a little, a teeny bit more risky, but with every uptick in risk, there's reward, and we've talked about a lot of the rewards, and a lot of that has to do with a lot of the reward behind taking on that risk is pretty high yield. Like I said, in some of these, a much better yield than you'd get in treasuries. But behind that good yield comes a little bit of added risk, and these tend to move a little bit faster than the overall market. And in my research, and I follow a lot of these stocks on a daily basis, and I noticed that they tend to rise with the market at a pretty steady pace. But when the market conditions start to get a little unstable, and think back to let's think about August, when markets are falling pretty fast. I noticed that REITs tend to fall pretty fast too. So I look at these as being slightly higher beta than just your average run-of-the-mill stock. And that basically all that means is that they're a little bit more volatile, right? And if you are dealing with unstable market conditions, it's best to use protective measures against these investments, like stops. Make sure that you keep those like you would any other stock, but just know that when the market gets a little fast, these tend to be pretty fast as well. So if you're dealing in unstable market conditions, these tend to get a little volatile. The next would be analytics and research. So if you want to conduct a fundamental analysis on some of these stocks, it's done a little bit differently. You see, PE ratios, earnings per share, they're not as relevant to these trusts. There's other forms of analysis that you're going to want to conduct, and we'll probably talk about that a little bit more in detail when we get through a little bit more of this presentation. But it's a slightly different spin on how you'd analyze. I mean, technical analysis remains the same, but fundamental analysis and the research. I mean, because you got to think about what some of these REITs are investing in. right? They do a lot of financing. They have a lot of floating credit. They have a lot of cash on hand, or some of them don't. Some of these companies, I've invested in them obviously a lot. Back during when the real estate market was really taking off, and when the market started to turn, I started to look at some of these companies, and it was, I don't want to say obvious, but it was pretty easy to determine which ones were going to get hit the hardest, and it was those that financed properties and took out loans at some of the most unreasonable terms. Those that were getting into higher interest rates. You notice that out of their revolving lines of credit, they didn't have much available. They were basically getting extremely leveraged, and I think it was easier, and some of those same companies ended up going through, bankruptcy issues and have since recovered. But there's a lot of things you need to take into consideration if you want to get into the fundamental aspect of this, and it cuts both ways. The technical analysis can obviously give you a good idea of who's performing better, who's performing worse, but the fundamentals I think are important to at least consider when you're looking at some of these investments. All right, so let me move on to the next slide here. The other considerations that I want to mention before we get through this presentation are that real estate valuations are a little less volatile than the overall equity market, and that's something to consider. We've gone through a market that's obviously trying to digest an awful lot of risk and an awful lot of things that we haven't seen before, and so right now there's a pretty high state of correlation, which means for the most part, when the market goes up, everything's going up. When the market goes down, everything's going down. We were at some pretty record correlations here over the last couple of years. But when those correlations start to abate a little bit, the real estate valuations, just in general, they're not as sensitive. They don't move as fast. So that's a positive in my opinion. That's something to think about. Also, you've got to think of just overall market conditions, and really, are the overall conditions to a point to where properties are well occupied, or whether there's a decent amount of vacancies. You got to think also too in terms of what market does this REIT specialize in. They might be You might be dealing with a REIT that has more exposure into, let's say, downtown metropolitan areas, or into maybe have more of a presence in suburbs. They could be just general housing areas, stuff like that, or shopping malls that maybe have a little bit more vacancies. Those are things you have to take into consideration too. Is what markets are they at? Where are these REITs? Where's their primary locations? And maybe do a little bit of poking around just to see in general. I mean, when you go to a shopping mall, do you notice that there's a few open slots? There's a few pads that are open. There's some vacancies. I think right now, based on the fact that, rental properties, apartments have been doing very well, right? The rental market's been up pretty well. So I mean, those are all things to take into consideration, because not all market conditions are just kind of a general go ahead when it comes to investing in real estate. I'm a firm believer in, really, there's probably times to invest in housing. There's other times to invest in apartment complexes. When economic conditions are good, that might be the time to look at office space or commercial real estate. So those are things to consider. Also, valuation. Where market's at, how these companies are valued, and competition. So for every segment of the real estate market, there's going to be multiple companies that we'll be looking at that have a presence. And you'll want to probably, when you're dialing down and you've got an idea in mind, let's say I won't pull out a specific stock just yet, but there's going to be a competitor. And I'm a firm believer when I analyze and I'm looking for a stock in relative strength comparisons. So if I've got 3 stocks that specialize in the exact same form, basically the same structure of a REIT, they're investing in the same type of real estate, those 3 charts aren't going to look identical, right? I mean, I'm obviously going to want to look for the one that's been performing the best, because that's going to tell me a lot about at least how the general investing public feels about the company. That's the great thing about technical analysis. It can kind of give you a bird's eye view of, well, which company's at least performing better. Which of those is going up and which ones are going down. That alone kind of gives you a good idea. I mean, if you're working with 3 stocks, one's at 52-week highs, one's at 52-week lows, and one's a little bit in between, at least it gives you a starting point of which one you want to avoid. Market conditions was something that I touched on a little bit, and the number one thing that you want to consider is supply and demand for property. Also, interest rates can be a really mixed bag when it comes to real estate investing. Rising rates, which is generally a good economic indicator, would mean that I always say, in rising rates, you want to rent more space, right? Companies are probably looking to expand, they're growing, and therefore they're renting more office space or purchasing more office space. But lower rates, there's a positive in lower rates right now, and obviously, we're in that situation. But what I've noticed specific to a lot of these real estate investment trusts is that because we have lower interest rates available right now, a lot of these companies have been able to refinance unfavorable debt situations to get better rates. So that allows them really, in a sense, to get more profitable and more productive. But off the cusp of a credit crisis, that can also mean that you want to check at what their revolving credit looks like and whether or not they're able to get financing, and if so, those are things to pay attention to. But last but not least is population and job growth, right? So if we're in and this might be a particular area, I can think of an area local to me that a few years ago was booming. They were able to start to extract a lot of oil from that location, and therefore not only were there no vacancies, I mean the homes were all bought up, but the hotels and the local motels, which were bringing in oil workers, were just bringing in a unbelievable amount of income for just ridiculous rates. The demand was so great that most hotels and motels you can go by and you can rates are generally going to be $100 a night, maybe a couple $100 a night for a nice place. But for some of the lower end motels and hotels, I mean, they were pulling in $250 plus a night, and people were paying it because they were able to get good work there. So population, job growth, I mean, these are all essential things to consider when you're looking at a particular area or looking at investing in any real estate. And that's going to be something that I think you need to have in order to really take on that kind of risk. So I've alluded to along the way a couple of different types of REITs. And tonight we'll focus specifically on equity REITs. And within that, there's a couple different segments, and that's healthcare locations and hospitals. Right, that's pretty straightforward. Then there's also hotel and motel, and so some of the considerations you might want to think are, well, are economic conditions good to where the consumer has enough money to where they're wanting to go on vacation? If so, they're going to be staying in motels. You might want to look at the company and see where their hotels and motels are strategically located. Do you want to have those in, tourist type locations, like major cities, or do you want to have them just kind of in the general outskirts of suburbs, right? So those are things to consider when you're looking at investing in a REITs that's looking specifically at hotels and motels. Industrial space, office space. I mentioned earlier about just overall economic conditions being a major factor in whether or not companies are renting or leasing more office space. If we start to see a better uptick, continued uptick in or downtick in unemployment, then those things might start to outperform a little bit. Now there's also residential, for the most part that's going to be apartment complexes, duplexes, and then we've got retail and commercial. So think shopping malls. I always think shopping malls. Are the shopping malls full? Are there stores that are closing out? If so, are they able to, to have people waiting? What kind of situations? And I just try to be an observer anytime I go shopping. That's the kind of stuff I do when I'm out. Is just take notice of that. Is there a lot of vacancies out there, or are properties full? Simple as that. Now, there's two ways that we can go about our analysis here. And really top-down or bottom-up analysis. We'll start with top-down analysis here. And I've got a couple questions before I do that. I'm going to just start real quick and just answer a few of these real quick. I was asked, when buying into a REIT, do I own a part of any of the underlying real estate, or do I simply own shares of the REIT? It's you own shares of that particular REIT, so you don't own a portion of the apartment complex or the retail pad that you're buying into, but rather you just own a share of that stock. So it's like I said, they trade just like a stock. So just like you would own a share of the company, you own a share of the REIT, and that's it. You're entitled to a dividend, but not entitled to the underlying properties. That's when I said earlier, it's kind of like a mutual fund. These properties are all kind of put into one trust under one umbrella, and you're just buying a share of that. Since there are many kind of REITs, what kind of stocks are there? We'll talk about a few of those. We'll call a few of those out and just look and get a few looks at those. And we'll also use that to get a good idea of yield, because yield, and I don't want to base any of our decisions specifically on yield, right? Because sometimes I always think when it comes to buying a dividend paying stock, a lot of people will go out and search just specifically on yield itself and not really worry about the underlying company. But remember, the higher that yield is, the more risk that's involved. And that means the more the stock could underperform. You could even lose on the underlying investment, which is the most important part. I mean, if you got to take on 1,000 shares of stock to get a pretty decent yield, well, that yield might pay me 5 or 6%, but I got to be really, really concerned about the underlying that I own, because that's what could really hit me. All right. So let's talk about the top-down analysis aspect of searching and deciding on a REIT. So I'm always looking for more favorable market conditions to take on more exposure via REITs. If this market, I tend to refer to the market as every so often it goes in, and you might have heard this, via different financial outlets or media pundits and whatnot, but they'll talk about the risk on and the risk off trade. Have you guys heard about that before? And simply when investors' appetite for risk is strong or whether it's pretty weak. Whether investors are looking to take on more exposure via equities or whether they're running over to treasuries because there's too much risk out there in the market. Gold is also a good measure of that. But I'm always looking for favorable market conditions to take on trades in REITs, and I'm a big believer in the fact that I think the REITs are a really, really, really good indicator, even on the intraday level. I actually use there's an ETF that I follow religiously that helps me determine whether the market is in risk on or risk on mode. So not only am I looking for opportunities to invest in individual companies, but I'm using this REIT, which is broken up of 84 individual REITs that kind of brings them all in, diversified amongst all of these, and it gives me a really good idea of whether the market is in that risk on or risk off mode, as it's commonly referred to. But I think the market's always got to be good. Well, not necessarily. That's to invest or to take a long position to buy any of these. But like I mentioned earlier, if you were a believer, back in the 2007, 2008, that the real estate market was in a bubble and it was primed to turn, you can also look at them from a bearish aspect. We can trade these things both ways. So there were a lot of traders that took on more of a bearish position, got short stock and bought put options on some of these companies and did fantastic. That's because, as I mentioned earlier in the presentation, a lot of these guys were really over leveraged. They were financed under some really just unfavorable terms, really high rates. And when the real estate market took a tumble, these stocks got hit really, really hard. So based on current conditions, current market conditions, if you follow the real estate market, you've got to determine which segment of REITs are in the best position to rise. So, I've followed the apartment rental markets really closely. I've followed the hotel and motel, which has been kind of on and off. And really, just all you're looking for is, and you can really get a decent glimpse of that just by looking at and doing a technical analysis of some of these individual stocks, just to get a good idea. But that's, like I said, apartments, commercial real estate, hotels. And also out of those, when you finally dial it down to, let's say you decided on, apartment complexes, which one of those come equipped with the best fundamentals, or even the strongest technicals. Now, the bottom-up analysis is this is kind of a shortcut, and at times I prefer this. And I'll give you an idea. Let's actually, before I go to bottom-up analysis, let's flip over here just really quickly. And there's probably about a dozen ETFs that track various Reits. So we'll start with the IYR, which is one of the most liquid. And in just looking at a 52-week chart, looking at the course of the year, you can kind of see just from a technical perspective, it looks pretty similar to the S&Ps. S&Ps are starting to approach highs, right? And the IYR is not far behind it. The IYR, which I think is it's kind of a general, you can see the category here, real estate. It's one that is the most liquid, and I think liquidity is an important thing to consider when you're looking for an ETF. And this is, ETFs are also a great way, I'm sure, as you know, to get a little bit of diversification. So let's say you're just a bull on real estate in general. The ETF is going to be the way to go. But if you want to start to segment it, let's say, I'm not bullish on real estate in general, but I'm only bullish on healthcare and healthcare facilities. That's when I might go into an individual stock and start to do my analysis there. But the REITs are a decent way to do that as well. And so the technical approach would be just simply looking at, well, okay, where does this stock rank amongst the overall market? Is it a laggard? Is it a leader? So on and so forth. And I'm a pretty big fan of at least getting a good visual idea of where that stock ranks before moving on. So in the bottom up analysis, like I said, the technical analysis will give you a visual idea of how they measure up. So if you get into a situation where you've got a few different stocks, some are at 52-week lows, some are at 52-week highs, my guess, and it's probably going to be a pretty good educated one, is when I start to look at those that are down at 52-week lows, they've probably got a lot worse off fundamentals, meaning they're not going to be attracting as many investors because they might have, their company might not be run as well, or they might have a lot of vacancies. They might have trouble, refinancing their debt, things like that. But it really just gives you a quick and easy idea of how they measure up. You can also select a REIT based on yield. But like I said, you might opt to, let's say, for you to go into the Scottrade into your account there and start to run a scan. You can start to put in some elements based on yield. And let's say you don't want to look for a yield that's less than 3 to 4%. That's possible, and you're going to get a handful of results back from that, and then you can start looking by yield, yes, but then also doing a little bit of technical analysis to see really who's top notch in that space. Who's been the leader. Like I said, relative strength is a really important concept of stock picking, and I'm a big believer in that. So rarely do I want to take something that's at lows when there's competitors up at highs. And then bottom-up analysis would be to select a yield based on type, right? And so let's say I'll go into MetaStock here, and in my chart platform, I'm in my little folder here that's got a few real estate investment trusts. There's some that are lower beta, there's some that are higher beta. There's some that move a lot more. There's some that move a lot less. Those are all things I think you need to take into consideration. I happen to know a lot of these individual stocks pretty well, and so therefore I've got a lot of preferences just based on my own preferential bias. Like there's because that space got hit so hard over the last 5 years, that I'm really going to be less excited to invest in those that, let's say, are cheaper, $2, $3, $4, $5 stocks. I mean, there are times when those outperform, but I think it takes a little bit of analysis and getting familiar with those to determine which ones are best suited for me. But I've got a few here, AIV, which is Apartment Investment and Management Company, so it's not going to take you a whole lot to determine where their specialties lie, right? Or we'll look at AVB, which is Avalon Bay. Oh shoot, I lost my settings here. Yeah, let me. I'll go back to the Scottrade website. I'm having a little difficulty with my charts here. No, I'll pull up a few here. So we looked at AIV just a moment ago. And we'll go out to the 1 year. And like I said, if I'm using the IYR to see what the overall benchmark is, and I always look to, if I'm going to invest in energy stocks, or I'm going to invest in material stocks or financials, I'll always go to the ETF that tracks all of them. Get me a really good diversified look at the overall space. And that's kind of the benchmark, right? That's at least how the average of all these companies is performing. So what I want to try to look for is, well, which one of these stocks looks a whole lot different than the rest of them, right? So AIV, when I look at that compared to the view we just took in the IYR, does it look all that different? It's approaching some of its summer highs, but it's not there yet, and neither was the IYR. So that's something I can look at just really quickly and say, okay, well, it's at least performing at the rate of the overall market. What about, we'll look at something like AGNC. And again, this one's a little bit pretty liquid as well. Liquidity is a really important aspect for me when I'm looking to take on. But notice this stock has kind of been in a range for the most part over the course of the last year. Approaching highs, but really not doing anything a whole lot different. And I'll go through right now. I'm looking at just those that specify in residential areas. So I'll look at a couple more, and then we'll move on. We've looked at AIV, AGNC, which again we'll also look at yield on some of these, and you can see AGNC is one of those that has a much higher yield. But if you look at what the stock has done, and I talked about that as being a measure of risk, really, you own a big portion of stock, but has it really done anything, right? Has the underlying stock perform well enough to justify the dividend? And that's obviously a personal preference, but been stuck in a range for over a year, right? We'll go to how about EQR, and then we'll look at a couple others. And just all I'm doing here is just kind of randomly taking a few of the most liquid stocks off of each one of these various different genres of real estate, just to give you a couple of ideas of who the competitors are, what they look like. And here's another one. It seems like this one's been coiling up pretty well and just now starting to exit away from this little coiling pattern, but again, right in the position to go up there and reach some of its former highs. Let's see how. So we've looked a little bit. These last three that I've looked at are residential companies. And if you have any that we want to take a look at, just to look at some of the charts, please feel free. But I'll look at a few here that specialize specifically in retail. And retail was one that I noticed it seemed to get hit a little bit harder when going back to 2008, 2009. I'll take you a look at Kimco, which is, I think that one trades the most. There's about three that I track pretty actively that give me just a good idea of how the retail real estate market is doing. There's Kimco, and it seems like it's gotten out of a nice little base here, like the overall market starting to approach highs, yield at 4%. I'll look at just a few more here. DDR, which is Developers Diversified Real Estate Corporation. Slightly lower yield, but you can see a lot of these are in the same position, approaching summer highs, but been on a really steep trend here as of late. And last one we'll look at is General Growth Properties, GGP. In fact, I notice every time I go to the mall, I see their stickers out on the doors of all the mall locations out here in my area, so I always know that they'll give me a pretty good idea of how local retail real estate is going out in my neck of the woods. But yeah, similar chart structure. Like I said, we're coming out of a position where correlations were at significant highs. It was hard to find something. It's hard to find a chart that's showing a lot of separation, right? Everything pretty much crashed in August, went down to new lows in October. Everything rallied in October. Everything consolidated in November. Everything pulled back in late November, and everything rallied from December until now. There's not going to be a whole lot of charts that look a whole lot different than that, but just kind of getting the feel of going through and looking through some of these. So let me just double check real quick here and see if we have any questions. GGP isn't bankrupt, but there have been a few that have declared bankruptcy and even a few that have come back out of it. I got a couple here, some ticker symbols that we'll look at really quickly. Larry, Ashford Hospitality Trust, he mentions AHT. That stock actually has looked pretty good lately. It's been performing pretty well. I noticed that stock had been coiling up really tight for multiple months and started to exit that. So let me zoom out a little bit. Yeah, you'll notice it was really wound up in a really tight range, trading around 8. And then just recently, nice little breakout, and it started to trend away from that. Started to take out some of these recent highs. Now, one thing that I would point out, Larry, is the one thing about this chart that makes it look different than its competitors. Notice where it was trading last summer. It was trading up between about 12 to 14. Notice that it hasn't gotten anywhere near those highs. So while a lot of the stocks that we were looking at just a little while ago are trading a little bit better, this one you can tell just by a quick visual interpretation, you can see that it's been lagging its peers a little bit. While its peers are a lot closer to those summer highs and getting up towards those, kind of like the overall market is, this stock just seemed to get hit a lot harder here in July and August. I mean, you look, and this stock was, gosh, went from a $14 stock down to a $6 stock. I mean, that's a significant percentage decline. Not only that, and this is what I say by, a lot of these stocks are a little bit higher risk. Yield on this is 4.4%, and yet I could own this stock, let's say I buy it at 12 and yeah, I'm collecting 4%, everything's all nice. And then all of a sudden when the market corrects, stock market comes down, about, 15%, 20%, but yet my investment loses about 60% of its value, 70% of its value or more. That's why I want to make sure I do a little bit of homework. I want to use some protective measures like having some stops on there. But lately, yeah, I mean it's had a nice little run just in the last few weeks. I've been watching that stock myself. And another one is B, Strategic Hotels and Resorts, which is a really good play off of the consumer, right? The consumer spending, traveling. These stocks all I was pretty active in trading these stocks. I'll take you back on a 5-year and show you. But there was that point there in early 2010 where these stocks had stayed in a base through 2009. Everything in 2009 was recovering, right? I mean, we just had a huge leg in equities, and yet you look at these stocks and they stayed down really low. They didn't want to advance, and that's because I mentioned, in 2007, 2008, I mean, these companies were absolutely scrambling to refinance debt. I mean, they were going to all of a sudden have a huge amount of vacancies. And I remember at that time there were a lot of pundits, and it was back in 2010. They're like, okay, commercial real estate's going to be the next bubble that's going to explode, and make sure where to short and how to go about doing that. I actually went in and started to buy a bunch of these stocks, and this was right as they started breaking out of these bases. What they did was these companies were in a really bad position. They got hit really hard, but they scrambled really quickly to get more profitable and to get more efficient by restructuring their debt. And by doing so, they were able to start leasing out some of their properties at much cheaper rates. And that's when a lot of these stocks, you look at strategic hotels. I mean, that's an investment I took on for a good period of time, multiple times in 2010. But those stocks were up about 100, 150% over the course of 3 months. And you look at something like this, no yield, right? I mean, that's a bad sign, right? That the company's even suspended dividends. But there are times when they're going to do pretty well, but you got to know. You got to be tracking them a little bit to know if they're restructuring and how they're going about doing that, and you'll see the strength in price when they start to run. But here, as of late, yeah, great trend, right? I mean, if take the stock from the $4 level up north of 6, I mean, percentage, it's a cheaper stock, which means it's a riskier asset. Not a lot of yield behind it, but when they tend to go in decent percentages. Larry mentioned SLG and PLD. Do we have any option traders in the crowd tonight? Anybody that likes to, buy calls, buy puts? If not, that's okay. We'll get you there. But what I tend to notice is that with a lot of these REITs is that the options are not as liquid. But that's, if you're an options trader, that's when you would want to go out to the to the ETF, where you got a lot more liquidity. SL Green. So this is actually a good example just to look at from a technical perspective. But again, so this is a stock that's lagged its peers a little bit, and just some of the ones that we've looked at. And SLG, these guys are in the retail aspect. It doesn't tell us here, but I know this company pretty well, but has been trading inside of a nice little base here, where it's up against some pretty good resistance from August, September, a little bit of October, November, maybe in a position to break out. But lately had a nice little run, trading really well, got a little bit of a trend to it. But most things do. The market's been performing pretty well, but maybe one of those breakout opportunities. And then let's go. Got a couple other questions in here I want to answer before I move on through the rest of the presentation. We'll look at a couple more stocks. Let's see, PLD, Prologis. We'll look at that. Which has a decent yield. These guys are more in the industrial aspect of real estate investment trusts. But decent yield, not a really high beta, but performance-wise, see, I look at this, and PLD was in a very similar position to that SLG that we looked at just a minute ago, and that is, a few weeks ago it was up against, that's about 28, 29, where it was up against some resistance, and now starting to travel back up to these old lows. SLG might be one just to keep an eye on and see if it behaves in the same manner, because this has been performing really, really well, Larry, as of late. But with any of these, I'd hate to be chasing them up too high. I think when it comes to investing in some of these REITs, because they are, they tend to get a little higher beta. If they start to pull back a little bit, I feel a lot of them pull back a little bit more than most stocks. So I generally always like to buy these into weakness. That's just a firm rule that I always trade by, is, never want to chase them up. Yeah, Bill, so you asked me about, Bill's question was, you're saying that when the big dip hits, REITs will go down percentage-wise with stocks. I'm just saying that they tend to get hit a little bit more. And you take a look at that, we were looking at BEE, Strategic Hotels and Resorts. And I just, think in terms of percentages. In July, up in the summer, the stock was trading north of $7 per share. And then all of a sudden in August, while most stocks were coming in about 15-20%, higher beta stocks were coming in, somewhere in the vicinity of 30 to 40%. This little stock right here went from 7, came all the way down to 4. Percentage-wise, that's a pretty big hit. So that's the kind of stuff that when they're moving up, sometimes they can move pretty well, but when markets are moving down, and they're moving down fast, I think the general perception is right now, like I said, I remember in 2010, a lot of people were calling for the next big bubble in commercial real estate, and how that market's going to absolutely implode, and all the all the bears were out there discussing how that was going to be the next big shoe to drop, and it never really was. But these stocks took the brunt of it, right? I mean, from a valuation, I mean, it seems like they kind of overshot their mark on how much these stocks should go down. So that's one thing that always concerns me, is if we're in bear market conditions, I definitely don't want to be long. All right. One last question I'll get to, and then we're going to move on, was David asked, are mortgage-backed securities like Anworth, ANH, Annaly, NLY, CIM, are they all REITs as well? They are. We've been talking more about the equity aspect as opposed to the mortgage-back. I kind of go back and forth on that in terms of risk. But you'll notice, David, that let's take a couple of those that you're asking. I'll start with Chimera, CIM. These tend to have higher yield. You look at Chimera here, and it's running just under 15%. But again, you got to look at the performance of the stock too, and what it's done over the course of the year. And that's just one. That's just one stock. We can look at. I'll look at NLY. Annaly's been a little bit more stable. All right, there we go. There we go. So if you look at this particular stock, ticker symbol NLY, the stock hasn't really gone anywhere, right? I mean, if you look at where it was a year ago, it was trading just under 18. When you look at it right now, it's trading just under 17. Yield is just under 14%, so that's a pretty sturdy yield. But I go back and forth of the risk of some of these mortgage-backed companies. So you'll see there are some pretty volatile dips in here, and that's relative to a $17 stock. The stock that can inside of a month spike down that much, but maybe against others it's not that bad. I mean, to answer your question, yes, they are forms of REITs. They do come equipped with high dividends, but you'll again want to do a little bit of a technical analysis to see how the stock behaves and whether or not that's within your level of risk tolerance. All right, so we've talked a little bit about bottom-up analysis. In fact, we did a little bit of bottom-up analysis there, just kind of running through a lot of individual ticker symbols. But I'm going to talk just really quickly about finding a REIT to trade. So as we've done here, you want to look for REITs that have outperformed, and there's I think 150 or a couple hundred individual REITs. So. But it's if you stick to those that are the most liquid, those that trade at least 500,000 shares, 1 million shares and up, it'll bring that list down to a much more manageable list to research. But I always, a rule of thumb is just straight relative strength. Consider leaders and avoid laggards. The stocks that are down near 52-week lows, I really don't have any interest in those unless I know that the company's in a position to start improving their business model and their profitability. So one thing that we didn't talk about that I think is really important is look for REITs with inside ownership. One thing that I think is really important is, do you have a CEO, or I guess we'll call him a chief investment officer or director, or executives, or somebody that's on the board? Are these guys are these guys a believer in their own investment? Are they heavily invested? Are they accumulating, or are they distributing? That's a really good thing to look at. Is, well, even if I use that as part of my bottom-up analysis, I'm not just going there and just see, well, which one is being acquired, which one are they buying up? That's going to tell you a whole lot, because these insiders, they sell for hundreds of reasons, right? But they buy for only one reason. Look for quality balance sheets. That's a tedious form of analysis. I mentioned earlier in the presentation that really earnings per share, PE ratios, those things don't apply here. So a lot of the fundamental analysis metrics that you typically use, they're not relevant. You just have to do it a little bit differently. So there are forms of analysis that you're going to want to use. There's a liability to value ratios. You can look at, a lot of these, a lot of their documents will show what their average interest rates are. Look at their cash positions. Do they have a lot of cash on hand, or are they cash poor? What kind of revolving credit do they do? But one of the most important things that I look at is funds from operations, because to be classified as a REIT, these guys have to kick out 90% of their profits as dividends to investors. That's why a lot of people trade in REITs, and that's why we consider it a risk-on trade. Is investors are willing to take that risk to capture that yield. So funds from operations is going to be a good metric to tell you how fundamentally healthy the company is. But finding a REIT to trade, guys, if you want just an umbrella, I really would urge you to start looking at individual ETFs, because number one, they're going to be a little bit lower beta because they're so diversified. And I'm going to flip back over to the Scottrade website here real quick, and I'm going to go. I went through the IYR with you earlier. It's the most liquid. The options are fantastic if you get into option trading, just based on liquidity, right? I mean, we need liquidity to trade, right? We need somebody to buy and sell from, and we need enough people that we can do so at razor thin spreads. But there's a couple others. Just jot these ticker symbols down so you can research them a little bit. We'll look at VNQ. Which this is done by Vanguard. Their yield is in the 3%. This one trades about 1.6 million shares, and you can see it's right back up against summer highs. So performance-wise, you can see it's just a little bit better than the IYR, but it's got about 1/10 of the liquidity, which may be important, maybe not. But that's always I won't trade an ETF unless it trades at least 1 million shares. But there's also, are you guys familiar with the leveraged ETFs? I don't know if I should introduce leverage to some of you. Maybe some of you might get a little too carried away with that. But if you're not an investor, let's say if you're just a day trader or a swing trader, then you might prefer to get a little bit more leverage, and you're not trading options. Leverage can form in the way of one of these leveraged ETFs. So Direxion does some of these triple leveraged ETFs. So these are 3 times the movement of the underlying here, which is a basket of REITs. Let's see here. Come on, I'm waiting on a quote here, so apologize for the blank screen. Let's see if it comes up here. Look, I might not get it. Try one more time. DRV. Maybe that's a sign that we shouldn't be talking about leveraged ETFs. There it is. Okay, so DRV is the bearish ETF. So if you are, this might be hard to wrap your head around, but if you're bearish on real estate, you buy the DRV, right? And it's a triple inverse equity. That might make your head spin a little bit, but notice that while REITs have been rising, take a look at what the DRV has been doing. It's been plummeting, and it's been plummeting pretty fast. I mean, you look at the range of this stock, and it's gone from just over 100 to now trading at 30. And the triple bull REIT, and these are, yeah, Larry, you mentioned that the volume is pretty low. It's a lot lower than the IYR, which is where I started you with. I wanted you to go with liquidity first, and if you like leverage, then you're going to want to go with options, because they don't. It's not a leveraged investment, but it is more liquid. This DRV, which is a little bit more liquid as of late, and you can see liquidity is kind of dried up here. They tend to get more liquid, and they tend to see much bigger volume. This thing used to trade over 1 million shares back in August, September, October. but that was when volatility was extremely high. So when we had a VIX that was trading up at the 30s, the 40s, and market was moving all over the place, these things were trading pretty actively. The investors' appetite for some of that risk was there, and you can see that these things were very, very actively traded, over 1 million shares per day. But in quiet, calm, low volatility markets like this, not so much. But the DRV and the DRN, which we're looking at right now, those are the triple leveraged ETFs that are focused on the real estate market. So, and then Evan, to answer your question, explain liquidity is liquid is how much, how many shares are out there available for you to trade. Basically whether the investment that you're looking at is, whether it's in high demand, whether it's actively traded, whether there's a large number of people that have interest in that same instrument or not, basically. And it helps you to be able to get in or out of said investment really quickly. Well, actually, I'm going to go back to the slide. The one thing about the IYR that I mentioned is it is a diversified investment. It's made up of a small portion of 84 companies. It does pay dividend, and the expense ratios are very, very low. So that's a good starting point. And then when trading these, I think the last thing to consider here is, I mentioned that these can be a pretty risky asset, but one of the best ways to combat that is to position size and diversify. It's the best way to manage risk. So don't jump in with just an overwhelming position size. Don't ever load the boat on any one individual stock. But rather keep it. I always tend to keep my position size to 1 to 2% of my account. So that way, if that investment ever blows up or something bad happens to me, I don't ever lose more than 1 to 2% of my bottom line. A couple of the ways you can go about doing this are to trade a basket of REITs with a smaller size, which is possible. What if you had a big amount to deploy, you'd rather just go out and buy, make up your own ETF, buy 100 shares of one stock, 100 shares of another, 100 shares of another, and do that multiple times. That's fine as long as you're trading them small. But the easier way and the less expensive way, and the way that's going to save yourself a whole lot of commissions, is to go with the ETF. So pick the top few candidates and trade those with bigger size. So if you want to just go in with one position, you found the one, you've done your bottom-up analysis, you've done your technical analysis, and you found the one that's trading really, really well, looks good to you, then you can go in there with bigger size, but just make sure you're using tighter stops. So guys, hopefully we've been able to delve into the topic of REITs. We've talked a little bit about what they are. We've talked a little bit about some of the benefits and the drawbacks to trading them. We've talked about different segments. We've gone into individual stocks and really talked a whole lot about it. So I'm going to turn the time over to you guys, and I know we've answered some questions along the way, which I appreciate you guys sending those in. Thank you very much. I always enjoy these sessions when we can be interactive and we can use a lot of the questions that you have to dictate the flow of the conversation. But if you have any questions you have that I haven't answered, or anything else about the presentation, or anything in general, feel free to fire away, and I'll leave it open for a few more moments of Q&A. Evan, you asked me, in my opinion, what sectors have potential in the next 18 to 24 months. I still am of the belief, I hate to go out on a limb here, and I'm more of a trader and more of an investor that delves in shorter term time horizons, and I used to delve in longer term time horizons until we saw a big storm that was coming back in 2007. And I knew that we would get into a market that was going to be pretty volatile, and it was going to have a lot of things to digest. So I honestly, to be honest, I don't see that far out just quite yet. If you were to ask me over the course of the next 3 to 6 months, well, I take that back. I mean, if I have one place that I think is going to actually has the best chance of seeing its own bull market for its own reasons, it's probably going to be biotech. That's a place that I'm pretty bullish on in the longer term, but it's going to be subject to fluctuations in the short term, just like everything else. But biotech and healthcare and those kind of things are typically more of a defensive asset class, and they tend to hold up a little bit better when the broad market pulls back. So that's one space I got pretty active in a couple months ago, and like what I'm seeing. The IBB, which is an ETF that tracks the biotech space, is at all-time highs, and that just happened over the course of the last couple months. Rich, the tax treatment of REITs is very complex on the level where if you want to become a REIT, there are a lot of qualifications that you have to meet. But as far as on your end, if you're just an investor in the shares, obviously I have to direct all tax-related questions to a tax professional. That's not something I'm in a position to comment on. But one of the great things about that is being a investor in a REIT itself is that you don't have to worry about the tax treatment other than the tax treatment of the capital gains or losses that you undertake in that position itself. So Evan, if it's specific, if your question was specific to real estate and which ones do I see doing best over the course of that lengthy period of time, I don't think it's anything that's going to be actionable today, but at some point the housing market's going to bottom, right? So that's going to be something when economic conditions start to get better and companies start hiring again, then things like office space, industrial real estate, those are going to be things that you want to look at. A lot of those companies, especially those that are really diversified in industrial, office space, commercial, those are the guys that got hit pretty hard. They haven't really come up off of their lows from a few years back. But I mean, you just think, what's the next economic event that's got to happen? Well, at some point, companies are gonna want to start hiring again, and we're gonna put a lot more individuals back to work. So I think at that point, when companies want to start growing a little bit and spending some of the money that they've been sitting on, you'd think they're going to want to start leasing and renting some more office space. So that's going to be, like I said, that's not here now, actionable today. That's not something I'd tell you to go jump on, tomorrow. But that's going to be something that you're going to want to watch over the course of the next year. Anastasia, on what time frame? You ask if I feel the stock market's been overbought. I think in the short term, yes, most indicators are pointing to an overbought market, but there's a pretty good tailwind right now, so it's not a market I would get heavily short. I would just wait for weakness to be a buyer. Got a good question here about are there any REITs that focus specifically on manufacturing facilities? Yeah, absolutely. But they're going to be pretty specific to well, I guess not necessarily. Those that are probably I like the diversifieds for that play because they're but I guess to answer your question, manufacturing, I think DCT, ticker symbol D as in David, C as in cat, T as in Tom, and that one's pretty liquid too. And PLD, we looked at that one earlier. I believe PLD has some exposure to that. All right, guys. Well, looks like we've reached the end of our Q&A, and I'll go ahead and wrap up the presentation. Really excited to be here with you this evening. Hopefully the presentation went well. Please feel free to forward along any feedback that you have, and we'll continue to do these sessions every few weeks. So I'll probably be seeing you back here at some point here in the future. Again, my name is Jeff Kohler, so if you have any questions that are needed to answer, you can reach us on some of the blogs on the website, and I can get back to you there. So, anyways, guys, I appreciate your attendance here this evening, and look forward to seeing you here again on the Strategy Session series. Thank you very much, and have a great evening. Good night.